Hey, welcome to CFA by NK, a podcast where we make sense of finance, simplify the CFA grind, and turn coffee-fueled nights into top-tier results. I'm NK, your CFA buddy, guide, and fellow finance nerd, here to help you smash those exams and maybe even enjoy the ride. If you're aiming for that CFA charter with confidence and minimal stress, you're in the right place. Let's get smarter, sharper, and one step closer to those 3 golden letters. This is CFA by NK.
Example, you want to calculate the NPV of an investment that will generate $500 annually for 5 years, with a discount rate of 10%. The formula would be NPV equals 500, 1 plus 0.10, caret 1 plus 500, 1 plus 0.10, squared plus 500, 1 plus 0.10, cubed plus 500, 1 plus 0.10, caret 4 plus 500, 1 plus 0.10, caret 5. Blank, underscore, blank. 3. Internal rate of return, IRR, and modified internal rate of return, MIRR. Both IRR and MIRR are methods used to evaluate the profitability of an investment or project. Internal rate of return, IRR, the discount rate that makes the NPV of all cash flows equal to 0. It represents the break-even point, or the rate at which the investment is expected to earn a return. OIRR is calculated by solving for the rate R in the NPV formula such that NPV equals 0. Modified internal rate of return, MIRR, a more refined version of IRR that addresses the problem of assuming that interim cash flows are reinvested at the IRR. MIRR assumes reinvestment at the project's cost of capital, or a different specified rate. MIRR formula, MIRR equals FV of positive cash flows, PV of negative cash flows, caret 1, N, 1. Where FV of positive cash flows equals the future value of positive cash flows, compounded at the reinvestment rate. PV of negative cash flows equals the present value of negative cash flows, discounted at the finance rate. Blank, underscore, blank. 4. Payback period and discounted payback period. The payback period is a simple method to evaluate the time it takes for an investment to recover its initial cost. Payback period, the time it takes for cumulative cash inflows to equal the initial investment. The shorter the payback period, the more attractive the investment. Discounted payback period, the time it takes for discounted cash inflows to equal the initial investment. It accounts for the time value of money, unlike the simple payback period. Blank, underscore, blank. 5. Real options valuation. Real options valuation is used to evaluate investment opportunities in situations where there is flexibility or uncertainty about future decisions. It is based on the idea that managers have the option, but not the obligation, to make decisions in the future that can affect the value of the investment. Types of real options. O option to expand, the opportunity to increase investment if the initial project is successful. O option to abandon, the ability to exit or terminate a project if conditions change unfavorably. O option to wait, the option to delay a decision until more information is available. Real options are often valued using option pricing models like the Black-Scholes model or binomial option pricing. Blank, underscore, blank. Recap, what you learned in Lecture 2. The time value of money, TVM, is a core principle in finance that emphasizes the value of money over time. Discounted cash flow, DCF, models are used to evaluate the present value of future cash flows. Internal rate of return, IRR, and modified internal rate of return, MIRR, are used to assess the profitability of projects. Payback period and discounted payback period are methods to determine the time to recover an investment. Real options valuation is a technique used to evaluate flexible and uncertain investment opportunities. Blank, underscore, blank. Mini quiz. Answer before Lecture 3. 1. What is the formula to calculate the present value, PV, of a future amount? 2. What is the key difference between IRR and MIRR? 3. Why is real options valuation useful in investment analysis? Once you've answered the quiz, say, ready for Lecture 3, and we'll dive into portfolio management and risk analysis. Keep going, you're making great progress. Let's move on to Week 4 Lecture 1. Portfolio Management and Risk Analysis. Lecture 1. Portfolio Management and Risk Analysis. In this lecture, we will cover portfolio management and risk analysis, which are critical aspects of investment management. As a CFA candidate, understanding how to build, manage, and assess portfolios is essential for making informed investment decisions and maximizing returns while minimizing risk. Blank, underscore, blank. 1. Portfolio management basics. Portfolio management involves constructing and maintaining a portfolio of investments that aligns with an investor's financial goals, risk tolerance, and time horizon. A portfolio is a collection of different types of financial assets, such as stocks, bonds, and other securities. Key concepts: asset allocation, the process of dividing investments among different asset categories, e.g., stocks, bonds, real estate, based on the investor's risk preferences and investment goals. Diversification, spreading investments across various assets to reduce the overall risk of the portfolio. Risk-return trade-off, the balance between risk and expected return. Higher returns are often associated with higher risk, and investors need to find an optimal balance for their risk profile. Types of portfolios. Active portfolio management involves making investment decisions based on market conditions and research, aiming to outperform the market. Passive portfolio management involves tracking a market index or benchmark, with the goal of matching the market's performance. Portfolio theory. Modern portfolio theory, MPT, developed by Harry Markowitz, MPT seeks to maximize the expected return for a given level of risk by diversifying investments. The key idea is that a portfolio's total risk can be reduced through diversification, as the correlation between the assets in the portfolio is less than perfect. Efficient frontier. The efficient frontier is a graphical representation of the portfolios that provide the highest expected return for a given level of risk. These portfolios are considered optimal, as they balance risk and return effectively. Blank, underscore, blank. 2. Risk analysis in portfolio management. Risk analysis is a critical part of portfolio management, as it helps investors understand the potential risks associated with their portfolios and take steps to mitigate those risks. Types of risk. Systematic risk, market risk, the risk that affects the entire market, such as economic recessions or geopolitical events. This type of risk cannot be eliminated through diversification. Unsystematic risk, specific risk, the risk that affects a particular company or industry, such as a product recall or regulatory changes. This risk can be reduced through diversification. Total risk, the combination of both systematic and unsystematic risk in a portfolio. Risk measures. Standard deviation measures the total risk or volatility of an investment's returns. A higher standard deviation indicates greater volatility. Beta measures the systematic risk of a stock or portfolio relative to the overall market. A beta of 1 means the asset's price moves in line with the market, while a beta greater than 1 means the asset is more volatile than the market. Sharpe ratio measures the risk-adjusted return of an investment. It is calculated by subtracting the risk-free rate from the return of the portfolio and dividing it by the portfolio's standard deviation. Formula. Sharpe ratio equals return of portfolio, risk-free rate, standard deviation of portfolio. A higher Sharpe ratio indicates better risk-adjusted performance. Example: if a portfolio has an expected return of 10%, a risk-free rate of 3%, and a standard deviation of 15%, the Sharpe ratio would be Sharpe ratio equals 10% to 3%, 15% equals 0.47. This means that the portfolio is providing 0.47 units of return for each unit of risk. Blank, underscore, blank. 3. Capital Asset Pricing Model, CAPM. The Capital Asset Pricing Model, CAPM, is a fundamental model used to determine the expected return of an asset based on its systematic risk, beta, and the overall market return. CAPM helps investors assess whether an asset is fairly priced relative to its risk. CAPM formula: expected return, RE, equals risk-free rate, RF, plus beta, market return, ROOM, risk-free rate, RF, where RE equals expected return of the asset. RF equals risk-free rate, e.g., government bond yield, beta equals beta of the asset, systematic risk relative to the market, ROOM equals expected return of the market. Example: if the risk-free rate is 3%, the expected market return is 8%, and the beta of a stock is 1.2, the expected return for the stock would be RE equals 3% plus 1.2 asterisk, 8% to 3% equals 3% plus 1.2 times 5% equals 3% plus 6% equals 9%. This means that based on its systematic risk, the stock should offer an expected return of 9%. Blank, underscore, blank. 4. Portfolio performance evaluation. After constructing a portfolio, it is important to evaluate its performance using various metrics. The goal is to assess whether the portfolio is meeting its objectives in terms of return, risk, and consistency. Performance metrics, alpha, measures the excess return of a portfolio relative to a benchmark, e.g., market index. A positive alpha indicates the portfolio is outperforming the benchmark. O formula. Alpha equals actual return, expected return, based on CAPM, Trainer ratio, similar to the Sharpe ratio but uses beta, systematic risk, instead of standard deviation. It measures the return earned per unit of systematic risk. O formula. Trainer ratio equals return of portfolio, risk-free rate, beta of portfolio. Example of alpha. If a portfolio has an expected return of 10% based on the CAPM model and its actual return is 12%, the alpha would be alpha equals 12% minus 10% equals 2%. This indicates that the portfolio outperformed the market by 2%. Blank, underscore, blank. 5. Efficient market hypothesis, EMH. The efficient market hypothesis, EMH, is a theory that suggests that asset prices fully reflect all available information at any given time. According to EMH, it is impossible to consistently outperform the market through stock picking or market timing because all information is already reflected in stock prices. There are 3 forms of EMH. Weak form, all past market prices and data are reflected in stock prices. Technical analysis cannot provide an edge. Semi-strong form, all publicly available information is reflected in stock prices. Fundamental analysis cannot provide an edge. Strong form, all information, including private insider information, is reflected in stock prices. Even insider trading cannot provide an edge. Blank, underscore, blank. Recap what you learned in Lecture 1. Portfolio management involves asset allocation, diversification, and the trade-off between risk and return. Risk analysis includes understanding different types of risk, using tools like standard deviation, beta, and the Sharpe ratio to evaluate risk and return. CAPM is used to determine the expected return based on systematic risk. Portfolio performance evaluation uses alpha, trainer ratio, and other metrics to assess portfolio performance. Efficient market hypothesis, EMH, suggests that markets are efficient, and it is difficult to outperform the market consistently. Blank, underscore, blank. Mini quiz, answer before Lecture 2. 1. What does the Sharpe ratio measure, and how is it calculated? 2. What is the difference between systematic risk and unsystematic risk? 3. What does a positive alpha indicate in portfolio performance? Once you've answered the quiz, say, ready for Lecture 2, and we'll move on to advanced portfolio optimization techniques. Keep going, you're on track for success. Let's move on to Week 4 Lecture 2, Advanced Portfolio Optimization Techniques, blank, underscore, blank. Lecture 2, Advanced Portfolio Optimization Techniques. In this lecture, we will build on the foundations of portfolio management and delve into advanced optimization techniques that allow us to construct portfolios that achieve the highest possible return for a given level of risk. These techniques are essential for those aiming to maximize their investment returns while managing risk efficiently. Blank, underscore, blank. 1. Markowitz Efficient Frontier, Advanced. The efficient frontier, introduced by Harry Markowitz, represents the set of optimal portfolios that offer the highest expected return for a defined level of risk. However, the advanced optimization techniques allow for deeper analysis, considering not just the risk-return trade-off, but also the correlation between asset returns. Key concepts: O diversification. By combining assets with low correlation, we can reduce overall portfolio risk. O covariance matrix. In Markowitz's framework, the covariance matrix is used to calculate the correlation between asset returns, which helps optimize the portfolio. O portfolio variance. Portfolio variance measures the dispersion of the portfolio's returns, considering the correlations between individual assets. It is calculated as portfolio variance, sigma squared p, equals sigma, ywj asterisk cov, re, rj, where y and wj are the weights of assets I and j, respectively. COV, RE, RJ, is the covariance between the returns of asset I and asset J. Example of constructing the efficient frontier: if you have a portfolio consisting of two assets, say stocks A and B, you would calculate the returns, standard deviations, and correlation between the two. Using these inputs, you can construct an efficient frontier to identify the optimal combination of these assets for different levels of risk. Blank, underscore, blank. 2. Capital market line, CML, and tangency portfolio. The capital market line, CML, represents the risk-return trade-off for efficient portfolios that combine the risk-free asset with a portfolio of risky assets, known as the tangency portfolio. The CML illustrates the best achievable return for a given level of risk when combining the market portfolio with a risk-free asset. Key concepts: risk-free asset, an asset that is considered to have zero risk, such as a government bond. Tangency portfolio, the portfolio on the efficient frontier that is tangent to the CML. This portfolio has the highest Sharpe ratio and represents the best combination of risky assets for maximizing return per unit of risk. Formula for CML equation: expected return equals risk-free rate plus portfolio return, risk-free rate, standard deviation of portfolio, standard deviation of market portfolio. Example of CML: if you have a risk-free rate of 2%, a market portfolio return of 8%, and a portfolio standard deviation of 20%, the CML would give you the expected return for portfolios that combine both risky assets and the risk-free asset. Blank, underscore, blank. 3. Black-Litterman model. The Black-Litterman model is an advanced approach to portfolio optimization that addresses some of the limitations of traditional mean variance optimization, like over-concentrated portfolios or overly aggressive weightings. It allows the portfolio manager to combine their market views with the covariance matrix to derive more realistic expected returns. Key concepts: market equilibrium. The model assumes that market prices reflect the equilibrium, the market consensus, about expected returns. Investor views. The model allows investors to incorporate their views, positive or negative, about certain assets, which are then adjusted based on the market consensus. The formula: O pi equals tau asterisk sigma m, where pi equals market implied returns, tau equals scaling factor, sigma equals covariance matrix of asset returns, m equals investor views. How it works: the Black-Litterman model adjusts the expected returns based on investor views. The final expected returns reflect a blend of market equilibrium and investor views. Example: suppose you are an investor who believes that stock A will outperform the market by 2%. The Black-Litterman model will adjust the expected return of stock A to reflect both the market consensus and your view. Blank, underscore, blank. 4. Minimum variance portfolio, MVP. The minimum variance portfolio, MVP, is the portfolio that minimizes the total portfolio risk, variance, without necessarily maximizing returns. This is a key concept in risk management, especially for investors with a low tolerance for risk. Key concepts: minimum variance portfolio, MVP, the portfolio that has the lowest possible risk for a given set of assets. Efficient frontier, F, portfolios on the efficient frontier with the lowest possible risk, considering the correlation between assets. Calculating MVP: the MVP can be calculated using the covariance matrix of asset returns and the weights of the assets. By adjusting the portfolio's weights, we find the combination of assets that gives the minimum variance. Example: if you have a portfolio consisting of stocks A, B, and C, and you want to minimize the risk of the portfolio, you would calculate the weights that result in the lowest portfolio variance. This is the minimum variance portfolio. Blank, underscore, blank. 5. Multi-factor models. Multi-factor models are used to explain the returns of a portfolio or asset by considering multiple risk factors, rather than just a single market index. These models can be used for more advanced portfolio management, as they account for factors such as interest rates, inflation, or sector-specific risks. Key concepts: Farmer-French 3-factor model. This model explains stock returns based on 3 factors: the market risk factor, the size factor, small versus large companies, and the value factor, high versus low book-to-market value. Carhart 4-factor model. This adds a momentum factor to the Farmer-French model, taking into account the tendency of stocks with strong recent performance to continue performing well. Example: if an investor is managing a portfolio of stocks, they could use the Farmer-French model to identify the risk factors that influence the stock returns and adjust the portfolio accordingly to optimize for those factors. Blank, underscore, blank. 6. Portfolio rebalancing. Portfolio rebalancing is the process of adjusting the portfolio's weights periodically to maintain the desired risk-return profile. Over time, asset prices change, and the portfolio may deviate from its target allocation. Key concepts: rebalancing frequency. Portfolios should be rebalanced regularly, e.g., quarterly or annually, to ensure the asset allocation stays in line with the investor's risk tolerance and financial goals. Rebalancing strategies: calendar rebalancing, rebalancing on a fixed schedule, e.g., every year. Threshold rebalancing, rebalancing when the weight of an asset deviates by a certain percentage, e.g., when an asset's weight exceeds 5% of the total portfolio. Recap: what you learned in Lecture 2. Markowitz efficient frontier, a key concept in portfolio theory, showing the set of portfolios that give the highest return for a given level of risk. Capital market line, CML, represents the best trade-off between risk and return for efficient portfolios. Black-Litterman model, an advanced model that combines market consensus and investor views to optimize portfolios. Minimum variance portfolio, MVP, the portfolio with the lowest possible risk for a given set of assets. Multi-factor models, models that consider multiple risk factors to explain portfolio returns. Portfolio rebalancing, the process of adjusting a portfolio's asset allocation to maintain the desired risk-return profile. Blank, underscore, blank. Mini quiz, answer before Lecture 3. 1. What is the purpose of the capital market line, CML? 2. How does the Black-Litterman model adjust expected returns? 3. What is the key difference between the Markowitz efficient frontier and the minimum variance portfolio? Once you've answered the quiz, say, ready for Lecture 3, and we'll dive into alternative investments and risk management. Keep going, you're doing great. Let's move on to Week 5 Lecture 1, Alternative Investments and Risk Management, blank, underscore, blank. Lecture 1, Alternative Investments and Risk Management. In this lecture, we will explore the world of alternative investments, which include non-traditional assets like real estate, private equity, hedge funds, commodities, and more. Understanding alternative investments is essential for portfolio diversification and risk management. We will also discuss risk management strategies that are crucial for managing these types of investments. Blank, underscore, blank. 1. Alternative investments. Alternative investments are typically those assets that fall outside traditional investments such as stocks, bonds, and cash. These assets are often used to enhance portfolio diversification and potentially provide higher returns, though they often come with additional risks. Types of alternative investments: real estate, investments in physical properties or real estate investment trusts, REITs. Real estate investments can provide income through rental payments and capital appreciation. Direct real estate investment, direct ownership of physical properties like residential, commercial, or industrial real estate. REITs, real estate investment trusts, publicly traded companies that invest in real estate and pay out income to shareholders. REITs allow investors to gain exposure to the real estate market without directly owning property. Private equity, investments in private companies, often through venture capital or buyouts. Private equity funds raise capital from investors to acquire or invest in companies, aiming for high returns through operational improvements, growth, and eventually selling the companies at a profit. Venture capital, a type of private equity that focuses on investing in startup companies with high growth potential. Buyout funds, these funds acquire established companies and look to improve their operations before selling or taking them public. Hedge funds, pooled investment funds that employ various strategies, such as long, short equity, event-driven, global macro, or arbitrage, to generate high returns. Hedge funds often take both long and short positions and may use leverage and derivatives to enhance returns. Strategy diversification, hedge funds can have varying strategies depending on market conditions and investor preferences. Commodities, physical assets like gold, oil, agricultural products, or other natural resources. Commodities are considered an inflation hedge and can be traded through direct investment or commodity-focused funds. Commodity futures, contracts to buy or sell commodities at a predetermined price at a future date. These can be used for speculative or hedging purposes. Private debt. Loans made to private companies or individuals, typically not traded on public markets. Private debt includes corporate bonds, loans to small and medium enterprises, SMEs, and other credit investments. Collectibles and art. Investments in items like artwork, rare coins, wine, or vintage cars. These assets are less liquid and require specific knowledge but can provide attractive returns in some cases. Benefits of alternative investments.